Hi, Steve Schlagel here. This is a picture that I took out of my backyard one day of a pretty sunset here in Farmington, New Mexico. And I'm not trying to show off a picture, but what I'm trying to do is get you to think about the fact that a balance sheet in your business is a snapshot or a picture of where your business is at any one point. I had a call the other day from a client who was having a hard time understanding why his cash balances were really good even though sales were down this year. And I said there can be a number of reasons for that, but for a lot of businesses it really comes down to three major things that you can look for on your balance sheet to understand your cash flow. And what I had him do was pull up a balance sheet that compared today to last year on the same day. What I was trying to look at was what was the change in events between that snapshot picture last year and the picture this year. We wanted to see what that difference was in three accounts: accounts receivable, inventory, and accounts payable. Because if you think about it, if our sales are down and our profits are down, how can our cash be up? How can we have more money in the checking account? Didn't make sense to him. And so one of the things I said was, take a look at your accounts receivable last year to this year. How did it change? And he said, well, it looks like my accounts receivable went down $100,000. And I said, does that mean that you have more money or less money? And he thought about it and said, well, I guess it means that I have more money because people have paid me off. It didn't create more sales, but it paid down the amount of money that other people owed me. So in effect, it put $100,000 in his checking account. And then I had him look at inventory, and inventory had changed by $50,000. It had gone down $50,000, which would also create $50,000 of cash. And accounts payable also went down by $50,000. Well, accounts payable goes down by $50,000. That means I had to use money to pay that. So often inventory and accounts payable move in pretty much the same way. That being the case, those two tend to offset in a lot of businesses, not always, but in a lot of businesses. So in his particular case, since the cash coming in from reducing inventory went to pay down the accounts payable that he had out there on that inventory, and it kind of washed out. So in his particular case, it was just a change in accounts receivable. So should he feel good about the fact that he now has $100,000 more than he thought he had, simply looking at his profit and loss statement, because his checking balances had gone up by almost $100,000. Should he feel good or bad about that? Well, he should feel good he got the cash. Cash is king, we know, but he should also be concerned about the fact that his sales were dropping and his profits were down, because that's simply, the reduction in receivables was simply collecting some cash. It's not making you real money going forward. So he still needed to go back and focus on sales and determine how to do a better job marketing to boost his market share and begin to increase his bottom line again. So don't manage your business by how much money is in the checking account, but understand why that money is in the checking account.